Well, other figures out Friday show that overall, the U.S. economy grew 2.5% last year. And that's below President Trump's much-touted 3% target for 2018. For insight into how all these figures add up, I'm joined by Joe Minarik, Senior Vice President and Director of Research at the Committee for Economic Development here in Washington. Thank you for joining us.
Happy to be here.
So economists were actually predicting 1.9% quarterly growth. It came in at 2.1%. What's your take on this figure?
It is a composite, of course, of different parts of the economy. And as you noted, Rachelle, we have strong consumer spending. A lot of that, by the way, was automobiles, which if you talk to automobile sellers, they're a little surprised at that because sales have seemed to be soft recently. And government spending was relatively strong. On the other side, and these are the indicators to which people would probably look to try to tell where the economy is going. Business investment was soft, and trade is obviously troubled, in part because of the administration's trade policies. So looking forward, where are we going to go? Not clear how long consumer spending and government spending can carry an economy that is weak on the investment side, and especially that is dealing with weak economies around the world and slow exports.
Now, we know a lot of people focus on that headline number. What is your main area of concern that you're seeing in the U.S. economy?
Probably the most important thing, and this is what the Federal Reserve has said, is a weak global economy and weak U.S. trade. So that is what is dragging the economy more than anything else. But then we start looking at that, what's going on. Well, some of that is really self-inflicted wounds. It is the U.S. trade policy, which is reducing to some extent U.S. exports, and at the same time, the U.S. is continuing to show an appetite for imports. Consumers are buying imports, and that's a detraction from U.S. overall economic output.
So then looking at what's happening in the economy, would you say it's in a condition where it really does need the Fed's intervention? And if so, how much?
Well, that is really a tricky question. You know, they always say you can't step into the same stream twice because it's always changing. This is a truly unique situation. On the one hand, inflation is low. It's so low that some people are concerned that the economy could fall into deflation, which is potentially a worsening cycle, and that's something you want to stay away from. On the other hand, unemployment is very low. There is concern that if we continue to stimulate the economy with low interest rates, that savers are not going to be satisfied with rates on bank accounts or bonds, and they're going to go into riskier assets, and that will cause asset price inflation. And beyond that, the Federal Reserve has got to be somewhat nervous that with the administration calling so publicly for reductions in interest rates, and with the Federal Reserve, of course, valuing its credibility in the markets, if it seems to kowtow to the administration's demands, it may sacrifice some of that credibility, which at some point in the future is going to be a needed asset.
And we have seen that called into question despite the Fed's defense of its position. Now, you mentioned inflation. We also have some analysts and also presidential hopefuls, including Elizabeth Warren, saying that a recession is headed the U.S.'s way. How likely is that?
Well, this is an expansion that many people would say it looks okay for an old guy, but it has been going on for some time. You end an expansion because of imbalances. Looking at the international sector as the greatest source of weakness, and looking at the problems that we have with trade policy, one might say that if we could get the trade disputes out of the way, we might look at extending this expansion for some time. Having low inflation is helpful in the sense that it means that you're not so concerned about rising interest rates. In good times with stable policy, people would see that as an opportunity to invest. We don't have that in part because of these self-inflicted wounds of economic policy.
And just quickly, given how low interest rates are, and if there is a cut as expected, how prepared is the U.S. economy for then another shock to the system economically?
That is one of the causes of concern. You want to have room to maneuver both ways. And the problem is with interest rates as low as they are, and if we are pushing the economy in effect into imbalances and into recession with interest rates that are excessively low, the Fed has no room to cut when they need to.
Certainly worth keeping in mind. Thank you so much. Always good to have you. Joe Minarik there, Senior Vice President and Director of Research at the Committee for Economic Development.